An ETF, or exchange traded fund, is like a basket that holds investments such as stocks, bonds, commodities like gold, or even real estate and crypto-related assets. Some ETFs hold a wide mix of different investments, while others focus on just one type or sector. One of the main advantages of an ETF, however, is that you're able to buy shares of one ETF and instantly own a piece of everything in that basket, instead of needing to buy hundreds of investments yourself. Here's how ETFs work. When you want to buy or sell an ETF, you typically go to an exchange just like you would when you want to buy or sell a stock. On the exchange, you buy or sell shares of the ETF from other investors when the market is open, and you see real-time prices as they change throughout the day. This up-to-date information makes ETFs attractive for both long-term investors and those who just like being able to see real-time pricing as the market moves. There are two kinds of ETFs, passively managed and actively managed. Passively managed ETFs track something called an index. And when I say track, I just mean that it simply tries to match what the index does, holding the same investments in about the same proportions, so if the index goes up or down, the ETF's value should move in a similar way. An example of an index is the S&P 500, which is made up of the 500 largest US companies. Think of companies with products or services you might already be familiar with, like Apple, Amazon, Coca-Cola, or Walmart. The difference between a passively managed and an actively managed ETF is that a passively managed ETF does not try to beat the market. In other words, using the same example, it aims to match the average return of those 500 companies. That's what people often mean when they say they're buying into the market. They're choosing to invest in an ETF that represents the market as a whole rather than trying to pick individual winners. Of course, it's important to remember that the S&P 500 only includes the largest US companies. It doesn't include smaller businesses, international stocks, or bonds, so while it captures a big piece of the market, it's not the whole market. Actively managed ETFs aim to outperform a benchmark rather than just mirror it, and are, as the name suggests, actively managed by investment professionals. Those investment professionals make decisions about what to buy and sell, instead of just following a fixed index with a set basket of investments. Because actively picking investments takes more effort and research, these funds often cost more than passive ETFs. ETFs have become increasingly popular over the years. One reason for that is their tax efficiency. When you want to invest in a taxable account, aka accounts that are not retirement accounts, ETFs tend to be more tax efficient than other investment structures such as mutual funds because of how they're designed. While many people hold ETFs in both retirement accounts and regular investment accounts, the major tax benefits apply primarily when you hold ETFs in non-retirement accounts, because retirement accounts are typically already tax advantaged. If you're considering purchasing an ETF but aren't sure if you want to go with the simpler, lower cost option of an index tracking ETF or an actively managed one, the best choice really depends on what you're comfortable investing in and your family's long-term financial plan. Keep in mind, all investments involve risk, including ETFs. Their value can rise and fall with the market, and when you sell, you may get back more or less than what you paid. If you're thinking that an ETF and a mutual fund sound similar, I'll be breaking that down very soon. Thanks for watching.